Hi everyone, my name is Jeff from Edu Network. Um, so today I just want to explain and help whoever needs assistance in understanding the standard IS-12. So I'll just be brief and explain the concept of deferred tax liability. So let's get into it. All right, so many times students struggle on how to incorporate tax in accounting. Okay, so it is very essential and very important that you have your tax background, right, in order to understand this topic. All right, so remember we have what they call income tax, which we always hear about. But what you should know is that this income tax is a combination of current and deferred tax. So current tax is the tax liability, right? Liability is simple what you owe to SARS, right? What you're supposed to pay over to SARS according to the SARS calculations, right? And then deferred tax is just an accounting term, all right? Because we are saying that there are actually some entries, right, in which we would have entered in our records, which SARS treats differently. Okay, so that will then bring about your what? Your deferred. Deferring is postponing something. All right. So you're deferring something, right? So it's either you are deferring a benefit or you're deferring a liability. So when you're deferring a benefit, it's called deferred tax asset, which we'll do on our next video. But today I want to explain on the deferred tax liability, right? So I'm just going to use a simple example. Don't worry about the figures. What's important is for you to understand the principle behind, right? What I'm trying to bring across. Okay. So what we know is that the other thing that I will explain is what they call a taxable temporary difference, right? Many times people struggle with the taxable temporal difference and the deductible temporal difference. So a taxable temporal difference, which are temporal differences that will result in taxable amount in determining taxable profit, right? So we are saying that it becomes a taxable amount. Right. So what does all this mean? So let's go to the simple example that I'm going to show you. All right. So let me share the screen. Okay. So as I said, we're just going to deal with the income tax, right? Then there is current, there is deferred tax. And then I said today, we're going to do deferred tax liability. So there is an example. We have a company that has income of how much? Of 1 million, right? And then they bought a machine for how much? For 600,000. And then we are saying according to our accounting, which is IAS 16, right? We are going to depreciate the same machine over how many years? 4 years. So I took the liberty and calculated for you. So we get a depreciation of how much? Of 150. And then for the same machine, SARS says we are giving you guys how many years? This is 2 years, right? Just an example. But I know that for those that understand their taxation, normally when it comes to a manufacturing machine, it's either 5 years or 4 years, right? But we're just going to keep this as simple as possible because I'm trying to bring across on the explanation of deferred tax liability. So we are saying 2 years divided by 6, we're still using the same cost because it's still the same machine. Because remember, you're going to declare that to SARS. Then SARS says, okay, for this machine in this condition, we are going to allow you to claim the cost over 2 years. Then that means that brings us to what? 300. So we have 150 and 300. Now remember, I'm trying to explain the concept of deferred tax liability. So there are the different records. So this is the entity record. These are the cells. So we are assuming that if everything remains constant, right? This company is making a sales of what? Of 1 million each year for 4 years, right? And then we're saying the depreciation, right, is 150 per year. Then we have the 4 years. So our current year is this one. Then these are the future years. So we are now saying that the profit before tax will be how much then? 850, right? For the 4 years. And then remember our rate is 27. 27 times that, we get the tax amount. So this is the information according to the accounting records, right? Because we have different rules, right, on how we treat assets. So our taxation according to the accounting is 225, right? Is 229, sorry, 5. But SARS says, okay, we agree with yourselves, okay, same thing. But when it comes to the wear and tear, right, current year, we have that. The next year, we have that. Then for the remaining 2 years, right, there's nothing. That's where the secret is, okay? And then let's look at the taxable income. So here is 700, 700. Here it's 1 million, 1 million, right? There's a relevance in these amounts, right? So I'm just going to explain that. Then I hope you will understand. And then this is the tax liability, right? At 27% of 700, you get this, that. Okay. So here, why then do they say that there is deferred tax liability? Remember, a liability is what you're owing, right? If you're owing someone, it's a liability, it's debt. Okay. If you're owing a shop, right, you put something on credit, you're owing them, it's a liability. All right. So then, but we are saying this liability is deferred. What's going on? Let's analyze these records. All right. So what SARS is saying, this is how I usually explain, right? We are saying, according to our records, right, this is the profit before tax. And this profit before tax, right, gives us a taxation at 27% of how much? Of 229,500. Okay. But for the same information, right, that you submitted to SARS, SARS applied their own rules. And then the difference was here. So what SARS is simply saying to us is that, okay, you see, you guys got a different profit before tax. We got a different amount. So we are actually taxing you on a lesser amount. Instead of also getting this value, we got how much? 189. So there's a difference. Okay. So in other words, SARS has lost out in 2024 because they were expecting to get this 229, right, to go into their what account. But only how much is going in? 189. So now we are saying there is a difference, okay? There is a tax, right, that we have then deferred, that we are owing SARS, okay? Because why are we owing SARS? Because SARS also compared that to your records. Your records are saying tax is supposed to be 229, all right? But SARS is getting 189. The SARS says it's okay, right? We will redeem that figure in the future. That's why it is then called a liability. All right, so here, let's go to the next page, right? Let's look at the difference. So if you say 229,500 minus 189, you get how much? 4,500. So this is the taxation that SARS has missed out in 2024. Okay, and then I took the liberty and gave you the what? The calculation according to this table. All right. So if you carrying amounts from your accounting, remember it's a cost minus depreciation, accumulated depreciation. Here it's going to be a cost minus allowances, right, for year one. Okay. So it's a simple what? 600 minus 150. Here it's 600 minus what? 300. Then you get this. Then this minus that, you get how much? 150. 150 times 27, you get 4,500. So this is the tax portion, right? Why are they saying tax portion? Because this is the taxation amount. This is the taxation amount. Okay. So if you say this minus that, you get that 4,500. So we have deferred, we have delayed a certain taxation payment over to SARS. So SARS lost out on tax temporarily in 2024. Same thing happened in 2025. This minus that. They lost out on what? On the same figure. Okay. But now in 2026, let's analyze, right? Our taxation according to the accounting records is 229,500. But according to SARS now, the tax liability is how much? Is that? So they are redeeming the 4,500 that they'd lost out here. Right. So I just kept this as simple as possible to just use one asset. But remember, in your exam, you then have other assets. Okay, that's why you then have a movement, because it's a combination of different assets, okay, that will treat it differently. So the overall movement will affect your what? Your current tax. All right, but that is for later. Okay, so you see, this is now being redeemed. Here SARS lost out, here they're now redeeming. What do you mean by redeeming? Because if you analyze now, remember, in taxation, if you have got an allowance, it actually reduces your what? The amount that SARS wants to tax. Instead of taxing 1 million here, they taxed 700 in year one. And in year two, instead of taxing 1 million, they taxed how much? 700. What caused that? Because you have deductions. But in 2026 and 2027, you no longer have deductions because SARS said you can only claim this cost over 2 years. So for the remaining years, there's no deduction. Therefore, your taxable income becomes more. And when taxable income is more, if you multiply that by 27, you then get a higher tax liability. So what is happening is, in other words, SARS is redeeming their tax that they'd lost from you for the previous 2 years. Okay. How do I know this? If you say 270 minus 229,500, you get how much? That amount. That's why it's called a liability. So you are delaying payment. Okay. So the next time we're then going to do deferred tax what? Assets. Okay. So thank you very much for joining me. Can you please tune in? And for more information, you can either call on these numbers or get the info, or just send us an email, right, on this address. Okay. So thank you very much. We'll send another video in the coming week. Thank you and goodbye.